Ladies and gentlemen, boys and girls, today, Strongman Personal Finance is going to explain to you how mortgage interest actually works. Because when you pay your mortgage payment, you're not just paying the principal, you're also paying interest. Take notes. Like and subscribe too. All right, welcome back everybody. Today, we're going to talk about mortgage payments. Very exciting stuff, okay? What is a mortgage? Well, if you want to buy a house, unless you're a billionaire like me, you're going to have to take out a mortgage, okay? That mortgage is a loan from the bank that you have to pay back with interest, okay? So in this example, let's say you take out a mortgage with no down payment, because you're a veteran. You take out a mortgage for $250,000. Your rate, your annual rate, is 3% of that balance. And your monthly rate, you take 3%, you divide it by 12 months in a year. 3% divided by 12 gets you 0.25% monthly. It's very important, okay? Your payment, based on the mortgage calculator, $1,054.01 delicious cent every month. That's just your mortgage. That's not your Jesus, drawing a blank. Your freaking insurance, taxes, whatever. That is just for your mortgage, okay? So your real payment in real life would be a little bit higher. Your term, this is a 30-year mortgage, okay? Now, before we get into this amortization table, we're gonna talk about how you calculate how much interest you're paying every month. All you have to do is take your current mortgage balance, which is your debt. Remember, you took out a loan. That's your mortgage. It's not your house. You take the balance of the mortgage, which in the first month is $250,000, and you multiply it by the monthly interest rate, which is 0.25%. Now, to convert this percentage to a multiple, you move the decimal point over twice, okay? Like that math? So it's your mortgage balance times 0.0025. I know, that's a ton of numbers, but I think you'll catch on quick, okay? So month number one, this is your first mortgage payment. Your first payment is gonna be $1,054.01, but you're gonna pay $625 of interest and $429.01 of principal, okay? Now, interest is just the bank making money off of you, okay? This $625 is not going to pay down this $250,000. This is going directly into Banky Boy's pocket, okay? This principal, this $429.01, is going to reduce your balance from $250,000 to $249,570.99. Does that make sense? So your mortgage payment of $1,054 is split between interest, which goes to the bank that does not pay down your loan, and principal that pays down your loan balance. Okay? So in the first month, your balance from $250,000 after you make your first payment is now $249,570.99. Moving on. So how do we calculate the interest for the next month? Are we paying interest on the $250,000 or are we paying interest on this number? 5, 4, 3, 2, 1. We're paying interest on this number, okay? You've already made a small principal payment and you've reduced your debt balance to this number. So now you go back to your formula and you say, okay, what is my current balance? And you multiply it by the monthly rate. So let's see what happens. Month number 2. Same payment. Your payment's the same every month. But how much interest you pay and how much principal you pay down is different. Your interest payment for month number 2 went down from $625 to $623.93. And your principal payment went up by $430 from this to $430.08. Okay? Now if you think about it, if you took this table and you extended it for 360 months, which is a 30-year term, what you would observe is that every month you pay less and less interest because your interest is calculated on your loan balance. This was your beginning balance before you made any payments. You make your first payment. This is your new balance based on the principal payment. Then you calculate the next interest payment based on your current balance. So boom, it's going to be a little bit smaller because you're calculating from a smaller balance. Does that make sense? So now, in month 2, you've paid $430.08 towards your principal. And this is now your new mortgage or your debt balance, okay? So take a stab at it. What do you think month 3's interest is going to be? Is it going to be higher or lower than month 2? You've probably already peaked. Maybe I'm not blocking it. It's going to be lower because the interest is calculated on your mortgage balance. So over time, this interest column, the numbers are going to get smaller and smaller and smaller. And your principal column, numbers are going to get bigger and bigger and bigger and bigger. So what you're doing is when you first take out a mortgage, you can deduct that mortgage interest on your tax return if you itemize. If you don't itemize, you're not going to deduct it. You get that tax benefit more upfront. And as you pay down your loan balance, the interest goes down and down and down, and you get less and less tax benefit, okay? So if you want to buy a house, and I've talked about this before, if you want to buy a house, a starter home, whatever, and then you want to sell it after 5 years, you're not going to profit as much as you think because you're not building a ton of principal based on this payment. Your principal is small. Your equity is small. Most of your money is going to interest in the first couple years, 10, 15, 20 years of the loan. And as time progresses, then you start paying more principal. So the whole point of this video, ladies and gentlemen, is to number 1, understand your mortgage payment is not all going to pay down your loan balance. You're only paying a small percentage of that balance down relative to your payment, okay? I also showed you how to calculate your mortgage balance. It's really not hard. You take your annual rate, you divide it by 12. You move the decimal point over twice, and you multiply it by your balance, okay? Now this whole thing is called a mortgage amortization table. You can Google it. It's pretty simple, and it'll break down exactly how much you're going to pay. You can change the mortgage amount. Like I said, that's your debt. That's not your house. You can change the interest rate. It'll give you a new payment, and you can change the number of years. Okay? Does that make sense? If you like this video, hit the like button and subscribe to my channel. You guys have a wonderful day.